Hi students. When we browse the balance sheet of a company or a firm, we often see an item in the asset side of the balance sheet listed under the heading goodwill. So what is goodwill is about and how it can be expressed in monetary terms. So I am inviting your attention to my lecture 3 with regard to the concept of valuation of goodwill in the partnership accounts. So here we will deal with what is the concept of goodwill under different angles and the role of goodwill in the partnership accounts and the valuation of goodwill and the adjustment entries required to be passed in the partnership accounts and the effects and adjustments of goodwill to the partners accounts. So as far as students are concerned, for the purpose of examination, the adjustment of goodwill is inevitable, especially during the process of admission, retirement or death. So be ready with the lectures and be prepared. Take a pen, a book and a calculator. Moving into the topic of valuation of goodwill. For the purpose of understanding, I am splitting the term valuation of goodwill into two. First one is the valuation, second one is the term goodwill. So what is valuation? What is valuation is about? So you might have heard a term historical cost or purchase cost. What is historical cost? What is purchase cost? When to explain the historical cost, for example, when I went to showroom, a car showroom for purchase of a car, the dealer will explain the cost details. What is the on-road cost? What is the insurance cost? And he will list out the various costs for the purchase of that car. That is called as the historical cost or purchase cost. Okay, that is the cost of the asset. But when I went to purchase a second-hand car, the situation is different now. There is no listed quoted price for the second car. The seller will give his perception of the value of the car, and I will not agree with that price. I may not agree with that price. I will go for negotiation. So in that case, I will value the car, the second-hand car, and the purchaser also value the second-hand car, and we will arrive at a negotiable price. So this is called as valuation. This is called as valuation. So for the purpose of valuation, there is no hard and fast rules. There is no specific part to compute the valuation. It differs from person to person. Though in practice we follow certain formula for the computation of intangible assets, say goodwill, but there is no hard and fast rule. So valuation is a concept which differ from person to person. The valuation, that is, we value items which is non-monetary in nature. Non-monetary in nature. Non-monetary doesn't mean that it has no value. The value is not readily available from the market. The value is not readily available from the market. For such assets, for such goods, we follow valuation. So valuation is different from the historical cost. Once the value is fixed, it becomes a historical cost. Okay. So valuation means a price, a value which is not readily available from the market, differ from person to person, and each person follow a different path for valuing an asset. Though in practice, I already said, there is a certain rule for the valuation. So this is all about the concept of valuation. Now moving to the goodwill. Goodwill is explained under different angles. The goodwill also viewed by different persons and different angles, and it is explained differently under different situations as well. So quite often it is usually to find goodwill under three heads. One is, this is the most popular phenomenon or term known as intangible asset, and secondly, the loss incurred in the sale or purchase of the business, and thirdly, as opportunity cost. So the goodwill can be understood under three angles. One is as intangible asset, secondly the loss incurred in the sale or purchase of the business, and thirdly the opportunity cost. So for the purpose of understanding the concept of valuation of goodwill, I am splitting the term valuation of goodwill into two. First one is the valuation and second one is the goodwill. So what is valuation? What is valuation? It is the process of valuing an item, computing the price of an item, computing the price of an item. I am focusing on the term computation. We are computing the price, the value of an item. So it is the monetary measurement of an item that is called as valuation. That is called as valuation. To make you understand more, let us deal with an example. For example, if I go for a purchase of a car in a showroom, car showroom, they will list out, the dealer will list out the price, what are the prices, what are the aspects of a cost included in the price of the car, the on-road price, the insurance cost, etc, etc, etc. He will explain all these aspects, and the cost of such price listed by the dealer is called as the historical cost of the purchase price. Historical cost of the purchase price, and this price will be similar for the car, for the same car in every showrooms. There may be different based on the values fixed, other values, other benefits given by the dealers, but in most cases the values will be quite similar. Okay. Moving to another example, when I go for the purchase of a second-hand car, whether value of second-hand car is available, the price of second-hand car is available from the market? No. The seller, based on the condition of the vehicle, based on the engine condition, based on the mileage, based on the kilometers operated, he will fix a price. So he will value the price. I may not agree with that price, or may not agree with that price, and we both, if I am the purchaser, we both have different perception with regard to value of the same car. So this is valuation. We will compute based on certain situations the price of that car. This is called as valuation of an item. Computing the value of item. So valuation is not the historical cost. Historical cost is the quoted price. It is readily available in the market. But the concept of valuation is different. For those items, the price for which is not readily available from the market, we should value the price of such items. This process of valuation is called as monetary measurement, or we say valuation. This process of computing the value is called as valuation. So valuation is done for non-monetary items. Valuation is done for non-monetary items. Non-monetary items doesn't mean that it has no value. Non-monetary means a value is there, it is to be computed, not available, not readily available from the listed price or from the market. So valuation is done for those items which are non-monetary in nature. So it is simple to say that goodwill is one of the non-monetary item we should value. So this is all about the valuation aspect. So remember, the concept of valuation is different from the concept of historical cost. Valuation means the person who is dealing with the item, purchase or sale, he should value that item. No price is readily available from the market. Moving to the concept of goodwill. Goodwill takes a different picture in the different scenarios. Different scenarios shows different picture of goodwills. Goodwill can be viewed in three angles. Some of them consider, not some of them, this is the most popular term, most popularly known term, which is the goodwill is considered as an intangible asset. The goodwill is considered as an intangible asset. So most popularly, goodwill is viewed as an intangible asset. Okay. And the second one is goodwill sometimes considered as loss. We will explain it in detail later. Then some of them view it as an opportunity cost. You might have heard this term, the economics opportunity cost. The benefit sacrificed. due to the acceptance of next best alternative. So some of them view the goodwill as opportunity cost. So the goodwill can be viewed, or goodwill step into the shoes of three anchors. What are three natures? What are the intangible asset, loss, and the opportunity cost? For the purpose of understanding the concept of valuation of goodwill, I will explain what is valuation and what is goodwill. And speaking about the valuation, the concept of valuation, valuation is the process of computing a value of an item. Computing a value of an item. Computing. I am emphasizing the term computing. Or it means assigning a value of an item, the monetary measurement. So, valuation is based on the concept of monetary measurement or computation of an value of an item. For example, to make it clear, for example, if you go for a purchase of a car in a showroom, first hand purchase, the dealer may list out the various prices of various variants of car, what is the on-road price, what is the insurance cost. So there will be a listed price. The dealer should not derive or arrive at a price. It is listed. It is provided by the dealer in the papers. Okay. So this price is called as purchase price. We may express in accounting term as historical cost. Okay. On the other hand, if you go for a purchase of a second-hand car, there will not be any listed price. The seller has to derive at the value. He has to assign a value to the second-hand car based on certain conditions, the engine conditions, the kilometers run, etc., etc. So, in the second case, the seller has to compute, derive a value, assign a value to the item. So this means that valuation, there may not be a readily available price. We have to derive at the value. We have to derive at the monetary terms. This is called as valuation. So in valuation, readily price is not available. We have to assign the value. So valuation is done on those items. Which type of items? Non-monetary items. Non-monetary items doesn't mean that it has no value, it has no monetary value. It means non-monetary means a readily value is not available from the market. So repeating, valuation is done on non-monetary items. Valuation is the process of assigning value to an item. So moving to the concept of goodwill. When I say goodwill, all of the students have a picture in mind that it is an intangible asset. Goodwill is an intangible asset. In accounts, goodwill can take three forms. One is the intangible asset itself. Then the concept of loss. Goodwill can be accounted as loss. Goodwill can be accounted as opportunity cost as well. So in accounts, goodwill can take three forms. One is the intangible asset, one is the loss, and the other is the opportunity cost. Okay, then again, when I ask what is an intangible asset, students may say, sir, it is an asset, neither be touched nor be seen. Pretending like God, cannot be seen, He is everywhere. It is not that intangible asset. Intangible asset, a mere definition of intangible asset cannot be confined, cannot be limited to neither be touched nor be seen. It should be interpreted in a different way. So what is intangible asset? We all know AS 26, Accounting Standard 26 speaks about intangible asset, the concept of intangible asset. So as per AS 26, intangible asset means it is an expenditure. It is an expenditure spent by the organization, from which we all know the concept of matching concept. Wherever there is an expenditure, there will be a benefit. Every benefit can be related with an expenditure. Okay, so it is an expenditure spent by the organization from which future benefit can be generated. So it is an expenditure from which future benefit can be generated. This alone does not create an intangible asset. Okay. thirdly, it has no physical existence. It has no physical existence. It doesn't mean that we cannot see it. Of course, it has no physical existence, but it has legal existence. A classical example is example of copyright, trademark, patent. There will be legal existence. There will be legal agreement to constitute, to have a right on as a patent, copyright or trademark. So it has no physical existence. It is non-monetary in nature. This expenditure, this asset is non-monetary in nature. Non-monetary again. For non-monetary items, we need valuation. So it is non-monetary in nature. So it is an expenditure which is spent by the organization, which gives future benefit and has no physical existence. It is non-monetary in nature. A readily price is not available from the market. Okay, it needs valuation. And finally, it is separable from other assets. Separable from other asset. It means that separable, the term separable stands for this asset is itself alone capable of generating income, generating benefits to the organization. This asset, this intangible asset alone can create benefits, future benefits to the organization. For example, to make it clear, to make you more aware, for example, in the case of a building, I am running a business in a building and building is owned by me, so it is my asset. I have other assets as well, furniture, fitting, electrical equipments, electrical fittings, etc., etc. Whether this business building, a business asset building alone can generate my income? No. It is a combination of, a coordination of assets. Building cannot create itself create a value to the organization. Of course it will create a value, but it alone cannot generate. It has to coordinate with other assets, computers, other services, other service assets, furniture, fittings. These all together create an asset. All together create an income. But in the case of intangible asset, it can alone create. That's why it is called as separable from other assets. So what is an intangible asset? What is an intangible asset? It is an expenditure spent by the organization which gives future benefit to the organization, has no physical existence, and it is non-monetary in nature, and it is separable from other assets. This is what exactly known as an intangible asset. You should not limit the definition to neither be seen nor be touched. Okay, is it clear for you? So AS26 speaks about the intangible asset. Then, in accounting, partnership accounting, we can see goodwill as an intangible asset in some cases only. It can be accounted as intangible asset only in the case of purchase or takeover of firms. Only in the case of purchase or takeover of firms. If a firm is taken over by another firm, or if the firm is taken over by another company, then there is a requirement for a valuation of goodwill as an intangible asset. And moving into detail, this intangible asset again can be classified into two. This intangible asset again can be classified into two. One is a self-generated intangible asset. Other is the purchased intangible asset. Again, this intangible asset can be classified into two. One is the self-generated, especially in the case of goodwill. There is self-generated goodwill because of my reputation, my efforts in the business, good services to the customers, competitive advantages, employee morale, which creates self-generated goodwill. And self-generated goodwill cannot be measured in monetary terms. It cannot be measured in monetary terms. We cannot measure the self-generated goodwill in monetary terms. But in the case of purchase goodwill, for example, when I purchase Jio, it is which has a good reputation all over the world. When I purchase Jio, I am a telecommunication company, I am purchasing Jio. Then in such case, I will purchase the name also, the goodwill also, because then only I can increase my sales, my revenue. In that case, that goodwill is called as purchase goodwill. That goodwill is called as purchase goodwill, it can be accounted because I'm paying a price for the purchase of that goodwill. So purchased goodwill can be accounted. So purchased goodwill can be accounted. So in the case of goodwill as an intangible asset, there are two types of goodwill. One is the self-generated goodwill, second is the purchased goodwill. Self-generated goodwill cannot be measured, cannot be accounted, and purchased goodwill is measured and accounted. So for the purpose of purchased goodwill, valuation of goodwill, the concept of valuation of goodwill is required. So this is all about the concept of intangible asset. Goodwill as an intangible asset. Moving to the next form, loss. This is, I think this will be a new knowledge for the students, considering the goodwill as a loss. Sometimes in the case, especially in the case of sale or purchase of business assets, we call it as net assets minus liabilities. When we purchase or sale of business assets, the difference between the net assets and the purchase consideration, sometimes treated as loss, and this can be accounted as goodwill. If, for example, if I sell my net assets of my organization and it cost net asset, the book value of asset. The book value means the value established in the balance sheet. Okay, book value of asset is rupees 10. This is the cost of the asset, and I sell these assets for rupees 9. The selling price is rupees 9. Then I had a loss of rupees 1. This loss can be treated or considered or accounted as goodwill. So this is another form of concept of goodwill. Goodwill can take in the form of loss also. It is a difference between the book value of net asset minus the sale value of net asset. If the sale value of net asset is less than the book value of net asset, then that difference can be treated as loss and can be accounted as goodwill. In such case, the goodwill cannot be treated as intangible asset because it is a loss. It cannot generate the future benefits to the organization. So it is merely accounted as loss, written off to the P&L account. And the third form, it is the most important form to be studied while learning the partnership accounts. Goodwill in partnership accounts almost takes the form of an opportunity cost. While doing the problems in the partnership accounts, we almost see the concept of goodwill as an opportunity cost. What is opportunity cost? The benefit sacrificed. While selecting the next best alternative, we have two alternatives. While selecting one alternative, we are sacrificing the benefit derived from the another alternative. This is the concept which is also applied in partnership accounts and treated as goodwill. So in partnership accounts, in most cases, we treat the goodwill as an opportunity cost, and we will study this aspect in detail. Before moving to the detailed discussion of goodwill as an opportunity cost, I will summarize the points what we have learned. Okay, so this is the form of goodwill and this is the application of the concept of goodwill. The form of goodwill, we already learned that three forms. Goodwill may take in three forms. As an intangible asset, goodwill is treated as an intangible asset in the case of amalgamation of partnership business. So while dealing with the amalgamation of partnership business, we will study in the later part. Okay. And in the case of taker of partnership business, the concept of intangible asset will come into play. Okay. Then in the case of loss, goodwill may take in the form of loss in the sale or purchase of partnership business. The difference between the net asset, book value of net asset and the sale value of net asset. And goodwill may take in the form of opportunity cost. See, this is the important aspect. Students, please note down in the valuation of goodwill. So while valuing the goodwill, in almost cases, we consider the goodwill as an opportunity cost. And also, in the process of admission, in the process of retirement, in the process of death, we already learned a concept which will explain in detail later. So in admission, retirement and death, there will be a concept of goodwill which takes the form of opportunity cost. So this is the summarized explanation of what we have learned earlier. Remember, intangible asset, amalgamation or takeover, loss, sale or purchase, and opportunity cost and valuation of goodwill, admission, retirement, death, etc. So now let us analyze goodwill as an opportunity cost. We all know, we are well aware of the fact that what is an opportunity cost. What is an opportunity cost? It is a benefit sacrificed due to the selection of next best alternative. These aspects are studied in your +1 +2 economics. Okay, so what is an opportunity cost? It is the benefit sacrificed due to the selection of the next best alternative. Now I am inviting your attention to 3 heads for the purpose of analysis. What is admission, then the retirement and death, then the amalgamation and takeover. Admission, retirement and death, and amalgamation and takeover. In admission, we already studied, we already learned, I already explained that in the case of admission, during the process of admission, the existing partner sacrifices. The existing partner sacrifices his share in the future profits. When another person is coming into the business, the incoming partner, the existing partner sacrifices his share in the future profits. So there is a term sacrifice. There is a concept of sacrifice. And for this sacrifice, the incoming partner should compensate. And how this sacrifice occur? Because of the change in the profit sharing ratio. If the new profit sharing ratio may be less than the old ratio, then the incoming partner should compensate to make good the loss of the existing partner. And this compensation will take in the form of goodwill, and this compensation is called goodwill in the process of admission. So in admission, the amount compensated by the incoming partner for the sacrifice made by the existing partners is termed as goodwill. For this purpose, we should value the goodwill. Okay, and moving to the retirement and death. Retirement and death, again, the person is going out of the business. He is sacrificing, he is surrendering his share in the future profits. And the existing partners will be in advantageous position. They will earn the gaining aspect. So in that case, again, the outgoing partner sacrifices his share. The existing partner should compensate the outgoing partner for this sacrifice, and this compensation is called as goodwill. So again, in the retirement or death, the concept of valuation of goodwill will apply for the sacrifice made by the outgoing partner in the future profits. And in the case of amalgamation of takeover, this is a broad concept. When a firm is amalgamated, merged or taken over by another company or another firm, then this company's future profit is sacrificed to the takeover company, to the other company. Had the company continued its business for n number of years, they might have earned profit, and this expected profit is sacrificed or given to another company in the process of amalgamation of takeover. Again, there is a sacrifice of future profit. Sacrifice of future profit. For this sacrifice, they will receive the sacrificed amount, the compensation for the sacrificed amount along with the purchase consideration, and this amount is called as goodwill. So again, in the process of amalgamation and takeover, repeating once again in the process of amalgamation of takeover, had the company continued to exist in the future n number of years in the future, they might have earned a profit. And now when the amalgamation or takeover takes place, this profit is sacrificed or surrendered to the other company, the purchasing company, and for as a compensation of this, along with the purchase consideration, they will receive an extra amount, and this extra amount is a compensation, and it is treated as goodwill. So the valuation of goodwill can take place in the process of admission to sacrifice the existing partners, in the process of retirement to compensate the sacrifice made by the outgoing partner, and in the process of amalgamation or takeover to compensate the sacrifice made by the selling company for the future profits. So this is all about the fundamental aspect of the valuation of goodwill. We generally follow 4 methods for the purpose of valuation of goodwill. One is the average profit method, then super profit method, then annuity method, and the capitalization of profit method. What are the methods? Average profit method, super profit method, annuity method, and capitalization of profit method. When we analyze these, the headings of these methods, see average profit, super profit, again annuity. Annuity is an extension of super profit method. Annuity method is the extension of super profit method where the time value of money, the concept of time value of money comes into apply. Then again the capitalization of profit method. So the valuation of goodwill, the concept of goodwill is directly related with the profit. That's why I explained that sacrifice of profit. Goodwill is as a result of the sacrifices of profit made by the existing partners in the case of admission, made by the outgoing partner in the case of retirement, and made by the firm in the case of amalgamation or takeover. So the concept of goodwill is directly related with the term profit. That's why we follow 4 methods: average profit method, super profit method, annuity method, which is the extension of super profit method where the time value of money concept apply, and capitalization of profit method. We will study, we will analyze, we will critically examine each of these methods in detail. Now let us discuss the calculations of goodwill under average profit method. And before moving to the explanation part of average profit method, let us analyze the concept behind the average profit method for the calculation of goodwill. What is the concept? Had the business continued for n number of years, they would have earned profit. The business would have earned profit. For example, if my partnership business had continued for n number of years, another 4 years, I would have earned profit. Therefore, the goodwill is equal to expected profit in the future. Into the number of years of expected existence. So what is the concept of goodwill under average profit method? Expected profit in the future. Had my business continued for a number of years, I would have earned profit. That is what is stated as expected profit. Expected profit in the future into number of years existence. This expected profit for a number of years is called as goodwill. And for the purpose of calculation of expected profit, we use the average profit of the firm of the last few years. We use the average profit. So based on this average profit, we predict or predict the expected profit in the future had the business continued to exist. So by using the average profit, we will predict the expected profit, and expected profit in the future into number of years of existence. We will get the goodwill. So let us see how we will calculate an average profit. First of all, I am explaining in a simple way. Then we will move into the detail aspect. So to express the average profit in a simple way, see, expected future profit is arrived at. First of all, look into the profit of past few years. The profit derived by the organization of the past few years, and then average the profit. These profits should be average. There are 2 methods for computation of average profit. One is the simple average method, the other is the weighted average method. So either by applying simple average method or weighted average method, you should average the past profits of the organization. Then adjust the average profit. With expected income and expenditure, with expected income and expenditure had the business continued. The business may expect some recurring incomes, recurring expenses. So it should be adjusted with the average profit. Then we will arrive the expected profit, which is called as future maintainable profit. Which is called as future maintainable profit. So this is the simple way of calculation of goodwill under average profit method. So repeating once again, what is the concept behind the average profit method? Had the business continued to exist for n number of years, then they would have earned some profit. So the goodwill is equal to, is a compensation of that profit lost. Okay, so expected profit in the future into n number of years of existence. So how we will calculate the expected profit? By using the average profit of the organization. So look into the profit of the past few years, average it by using simple average method or weighted average method, then adjust the income or expenditure, expected income or expenditure with the average profit, then we will get the future maintainable profit. Future maintainable profit into number of years of existence is equal to goodwill. This is all about the average profit method. Now we will deal in detail what are the aspects to be covered for the computation of average profit. Take an example on the computation of average profit. 3 examples are written here. Example 1, example 2, example 3. In the example 1, let us analyze the profit. 2016, year 2016, 25,000. 2017, 35,000. 2018, 20,000. 2019, 10,000. Okay. In the next 2 examples, let's see a trend in the profit. In the year 2016, 25,000. Next year, 35,000. The very next year, 38,000. And in 2019, 52,000. Here the profit shows an increasing trend. I'm going to the example 3. The profit shows a decreasing trend. In the year 2016, 25,000. 17, 22,000. 18, 18,000. 19, 15,000. See, if the profit shows either an increasing trend or decreasing trend, we will apply weighted average method. We will apply weighted average method for the calculation of average profit. So if the profit either shows increasing or decreasing trend, we will apply the weighted average method for the calculation of average profit. Otherwise, we just follow simple average method. For the calculation of average profit. So students, please note down. If the profit either shows an increasing or decreasing trend in n number of years, then we will apply the weighted average method for the calculation of the average profit. Otherwise, we simply follow the simple average method for the calculation. So let us compute the average profit under both these methods. Okay. See, the concept of weighted average method. The concept of weighted average method is that since it shows an increasing trend, we should give importance to the last year's profit. We are projecting the profit from 2020 onwards. For till 2019 the profit is given. We are projecting the profit from 2020 onwards. Therefore, we should focus our profit calculation on the last year's profit. Since it shows an increasing trend, we expect more than 52,000 in the coming years. And in example 3, we are expecting decrease in the profit. So we will expect a decreased amount than 15,000 in the coming years. So assign more weight on the latest years of profit. That is, since there are 4 years are given in the question, I am assigning a weight 4 to 2019, 3 to 2018, 2 to 2017 and 1 to 2016. The same way in example 3, assigning 4 to 2019, assigning 3 2018, 2 2017 and 1 2016. In this way we will assign weight. Then what is the average profit? Average profit is equal to okay, sum of profit into weight. Profit into weight. We will multiply the profit with the weight and we will take the sum. Our sum of profit into weight divided to sum of weights. Divided to sum of weights. In this way, we will arrive at the average profit under weighted average method. Repeating, how we will calculate weighted average profit? Average profit under weighted average method. We will assign a weight based on the latest trend in the profit, and sum of the profit into weight will be divided to the sum of weights. So in this problem, we will multiply 52,000 into 4 plus 38,000 into 3 plus 35,000 into 2 plus 25,000 into 1. In this way we calculate sum of profit into weight, that divided to sum of weights, 4 plus 3 plus 2 plus 1. Then we will arrive at the average profit. Then in example 3, 15,000 into 4, 18,000 into 3, 22,000 into 2, 25,000 into 1. We will total all this and divide it to 4 plus 3 plus 2 plus 1. In simple average method, the calculation is so simple as the name indicates. How we will calculate the average profit? Sum total the profit for the n number of years, 25,000 plus 35,000 plus 20,000 plus 10,000, then divided to number of years. So sum of profit divided to number of years, we will get average profit under simple average method. So this is the calculation with regard to the average profit under weighted average method. When we will apply weighted average method, if the profit shows an increasing or decreasing trend, we will apply the weighted average method. We will assign the more weight to the latest profit, and the profits are multiplied with the weights and divided to the sum of weights. And in simple average method, we will aggregate the total profit for the few years given in the question and divided to number of years. So this is the calculation about the average profit method. And therefore, under simple average method, average profit is equal to sum of profits divided to number of years, and under weighted average method, average profit is equal to sum of profit into weight divided to sum of weights. So this is the conclusion of computation of average profit under simple average method and weighted average method. Now let us find the solution on example 1, example 2 and example 3. Okay, in the example 1, which is based on a simple average method, the total of the profit for the 4 years from 2016 to 19 is 90,000 and 4 years. So 90,000 divided to 4, that will be the average profit under simple average method. So how much we will get? 90,000 divided to 4 is equal to rupees 22,500. That will be the average profit, rupees 22,500. In the second problem, which is based on weighted average method, we have assigned the weight 25,000 weight 1, 35,000 weight 2, 38,000 weight 3, 52,000 weight 4, and multiplying the profit with the weight, we will get 4,17,000. Then the average profit is equal to 4,17,000 divided to sum of the weights. What is the sum of the weights? 1, 2 plus 3 is equal to 10. We will get 10. 4 plus 3, 7, 2 plus 2, 9 plus 1, 10. So what is the average profit? 41,000 rupees, 41,700. In the third problem, which is also based on weighted average method, 25,000 weight 1, 22,000 weight 2, 18,000 weight 3 and 15,000 weight 4, we will get 1,93,000. Again, what is the average profit? 1,93,000 divided to sum of the weights 10. Therefore, rupees 19,300. So this is all about the average profit computation under various methods. Simple average, weighted average method. Is it clear for you? Moving on to the fourth example. The fourth example says the profit earned by an organization in 2016 is 12,000, 17 is 18,000, 18 is 16,000 and 19 is 14,000. That means there is no increasing or decreasing trend. And compute the goodwill valued at 3 years purchase. Valued at 3 years purchase. 3 years purchase means expected years of existence is equal to 3. We already discussed how we calculate goodwill under average profit method. Expected future maintainable profit into number of years of existence, expected years of existence. So the question says that the number of expected years of existence is equal to 3. So first we have to calculate the average profit by using the simple average method, since the question does not show an increasing or decreasing trend. So what is the average profit? What is the average profit under simple average method? Simple average method. What is the average profit? Sum total of all these profit. 12,000 plus 18,000, 30,000 plus 16,000, 46,000 plus 14,000, 60,000. So 60,000 divided to 4 years. So how much we will get? Rupees 15,000. So 15,000 is the simple average method's average profit. Average profit. So what is the goodwill amount? So goodwill is equal to expected profit into number of years purchase. I am writing this sentence as not as number of years of expectancy, number of years purchase. Okay, expected profit in the future. We got the average profit as 15,000. In order to figure out what is the future maintainable profit, we have to add or less the income or expected income or expenses from this average profit. But the question does not speaks about the expected income or expenses in the future after 2019. Therefore, we are assuming that the same average profit is expected to maintain in the future. So expected profit will be equal to the 15,000, rupees 15,000. So what is the amount of goodwill? 15,000 into 3. Therefore, rupees 45,000. So this is the figure of goodwill, rupees 45,000. So students, please note, while calculating the goodwill under average profit method, we have to compute the future maintainable profit. Future maintainable profit means the expected profit in the coming years. Okay. The average profit is computed as 15,000. Since the question does not speaks about the expected income or expenditure to be adjusted, we are assuming this 15,000 as the expected profit. Therefore, expected profit into number of years of expectation of existence. 15,000 into 3 is equal to rupees 45,000. Let us analyze the question number 5, example 5. Here the profit is given for 4 years. 2016 12,000, 2017 18,000, 2018 16,000, 2019 14,000. I have opted the same figures as in the case of example 4. And what this question says, the expected items in the coming year, expected adjustments in the coming year is, the firm expects, the partnership firm expects, had they continued in the future, they would have earned rupees 10,000 per year. They would have earned rupees 10,000 per year. And had they continued their existence, they would have expended 5,000 per year. So, unlike the previous problem, example 4, here we should calculate the future maintainable profit from the average profit. The adjustments to be made with the average profit. So, how we can adjust? First of all, what is the step 1? The step 1 is to calculate. What is the step 1 to calculate the average profit? What is the average profit? average profit. What is the average profit? 12,000 plus 18,000, 30,000 plus 16,000, 14,000, 46,000 plus 14,000, 60,000. So 60,000 divided to 4, we will get rupees 15,000 as the average profit. From this average profit, in the previous problem, we considered this 15,000 as the future maintainable profit because the question is filed with regard to the future expected adjustments. In this problem, we have to adjust the expected income and expenses from 15,000. So, step 2. What is step 2? Computation of future maintainable profit. 15,000 is the average profit. Okay. Then, plus 10,000 will be the expected income. Minus 5,000 is the expected expenses per year. So we will get how much? 15,000 plus 10,000, 25,000 minus 5,000, 20,000. So rupees 20,000 will be the future maintainable profit. Then what is the goodwill? And finally step 3, what is the goodwill? Goodwill is equal to expected future maintainable profit into number of years purchase, 3 years purchase, number of years purchase, expectation of existence. How much? Rupees 20,000 into 3, that is rupees 60,000. This is the goodwill. So unlike the previous problem, here we calculate the future maintainable profit by using the average profit. Moving to the sixth question, example 6. Profit for 4 years are given. In 2016, 12,000, 17, 18,000, 18, 16,000 and 19, 14,000. And other information is given as under omission of expenses. Omission of expenses in 2016. Omission of expenses in 2016 is rupees 2,000. That means from this from the profit of the 2016 is overstated by rupees 2,000. Had it adjusted in the year 2016, the profit would have been 10,000. By deducting 2,000, we will get 10,000. So there is an omission of expenses of rupees 2,000 the year 2016, and in the year 2017 there is an omission of income of rupees 12,000. So if it had adjusted in the year 2017, the profit would have raised to rupees 30,000, 18,000 plus 12,000, 30,000. So there are two omissions in the expenses and income. In the year 2016, 2,000 is omitted from expenses head, and in the year 2017, an income of rupees 12,000 found omitted. Then the expected income in the coming years is 10,000 and the expected expenses in the coming year is 5,000. You are required to compute the goodwill for 3 years of purchase. So again, comparing with the previous problem, example 5, we have dealt with how we have to adjust with the expected income and expected expenses. Question 6 gives a new picture, a new adjustment about the omission part. So if there is an omission in the previous years, the years given for the computation of average profit, then before arriving at the average profit, we have to adjust, we have to make an adjustment in the respective year's profit. Then only we can calculate the corrected average profit. So what is the step 1 here? The step 1 is to adjust the profit. So adjusted profit of 2016 and 17 is to be computed first. So step 1. In the step 1, adjusted profit. Okay, adjusted profit. Computation of adjusted profit for 2016. 12,000 minus 2,000, we will get 10,000 because it is an expense. It will be deducted from the profit. In 2017, 18,000 plus 12,000, we will get 30,000. As it is an income, we have to add addition to the 18,000, we will get 30,000. So in this way we will calculate the adjusted profit after considering the adjustment. Then the step 2, computation of average profit. Computation of average profit. Step 2, computation of average profit. Again, this does not show an increasing or decreasing trend, so we can use the simple average method. Instead of 12,000, now Here is 10,000 instead of 18,000. It is 30,000. So what will be the average profit? 10,000 plus 30,000, 40,000 plus 16,000, 56,000 plus 14,000, 70,000. So 70,000 divided to 4. 70,000 divided to 4 is equal to rupees 70,500. This is the average profit, and the question speaks about the expected trend. So we have to compute the future maintainable profit. So step 3, computation of future maintainable profit. How much? 17,500 plus the income part 10,000 minus the expense part 5,000. So we will get 27,000 minus 5,000. How much? Rupees 22,500. So this is the future maintainable profit. And at last, what is the goodwill? Goodwill, step 4. Goodwill is equal to how much? Rupees 22,500 into 3. We will get rupees 67,500. So students, please note, if there is any omission in the previous year, from the previous year's profit, we have to adjust first and calculate the adjusted average profit. Then only we can move into the calculation of future maintainable profit, goodwill, etc. Moving to illustration 7, example 7, the question says the profit for the year 2016, 12,000, 17, 18,000, 18, 16,000, 19, 40,000. And let us see what are the adjustments given. Abnormal loss included in 2016 is rupees 2,000. Abnormal loss. And again, abnormal gain included in 2018 is 6,000. So this is a new concept, abnormal loss, abnormal gain. In the previous question we have dealt with the omission aspect. Okay, abnormal loss and abnormal gain. So if there is any abnormal loss included in the profit, included in deriving at the profit, if there is an abnormal gain included deriving at the profit, then these to be adjusted before calculating the average profit. So abnormal loss means it will be deducted from the gross profit to arrive at the net profit. Abnormal gain, it will be added to the gross profit to arrive at the net profit. So what should we do? We have to eliminate that loss aspect, abnormal loss aspect and abnormal gain aspect. So in the year 2016, in this 12,000, there has a loss of 2,000 deducted from the gross profit to arrive at 12,000. So this 2,000 has to be added back. This 2,000 has to be added back. Previously it was deducted, now it is to be added back. Then in the year 2018, the profit includes abnormal gain of rupees 6,000. So abnormal gain, it was added to the gross profit to arrive at 16,000. Now what should we do? In order to eliminate the abnormal gain, it has to be deducted. It has to be deducted from rupees 16,000 to get the exact profit for the purpose of calculation of average. Okay, then the question says the future expected income 10,000 for the calculation of future maintainable profit, expenses 5,000, and compute the goodwill for 3 years purchase. So what is our first step? What is our first step? To compute the adjusted profit before arriving at the average profit. So step 1, what is adjusted profit? Adjusted profit. What is the adjusted profit? Year 2016, 12,000 minus, not minus, plus 2,000, because normal loss which has previously deducted to be added back. So 2,000 we will get 14,000. Okay, then for the year 2018, again for the year 2017 there is an adjustment, for the year 2019 there is an adjustment, for the year 2018 16,000 minus 6,000, because it includes 6,000 abnormal gain which was previously added. Now it is to be deducted. So we will get rupees 10,000. So this is the adjusted profit for the year 2016 and 18. Now what is the step 2? Calculation of the average profit. Step 2, calculation of the average profit. Okay, how much? Here 14,000, here 18,000, here 10,000, here again 14,000. So what will we get? 14,000 plus 18,000, 32,000, 42,000, 56,000. Yes, 14,000 plus 18,000, 32,000 plus 10,000, 42,000 plus 14,000, 56,000. So 56,000 divided to 4, we will get 14,000 as the average profit. 14,000 as the average profit. And what is the step? Step 3, computation of future maintainable profit. Step 3, computation of future maintainable profit. How much? From 14,000 we have to adjust 10,000 and 5,000. So 14,000 plus 10,000 minus 5,000. What will be the resulting figure? 24,000 minus 5,000. 19,000. So rupees 19,000 will be the future maintainable profit. And what is the goodwill? The goodwill. Step 4. What is the goodwill? 19,000 into 3. Future maintainable profit into expected years of existence. Number of years of purchase into 3. So how much we will get? Rupees 57,000. So this is the way we calculate the goodwill if there is abnormal loss, abnormal gain. So students, I am concluding my discussion on the computation of goodwill based on the average profit method, and let us recap what we have studied. Okay, so under average profit method, how do we calculate goodwill? The future maintainable profit into number of years purchase. The future maintainable profit into number of years purchase. And what are the steps? As step 1, we will compute the adjusted profit if any. If the average profit, the profit given in the question has to be adjusted by way of omission or abnormal items, then first of all we will calculate the adjusted profit, and after calculating adjusted profit, in the step 2 we will calculate the average profit. If there is a trend in profit either increasing or decreasing, we will apply weighted average method. If there is no such trend, we will apply simple average method. Then after calculating the average profit, step 3, future maintainable profit has to be ascertained. So what is future maintainable profit? The profit that is expected had the organization continued to exist. And how we will calculate this? From average profit, we will adjust with the expectations, the expected income and expected expenses. We will adjust with the average profit to arrive at the future maintainable profit. And if such expectations are not given in the question, then assume the average profit is equal to future maintainable profit. And in this way, this goodwill is calculated by by multiplying the future maintainable profit with the number of years purchase. So this is all about the average profit, and I will discuss about the super profit, annuity method, and method based on the capitalization of profit in the next class. So this is all about my lecture 3. Thank you.